We have maybe a big Fed decision coming up in September. They're expected to lower rates, but it is sort of a dilemma here because they've got inflation really not coming down the way they would like it to be, and now some bad news on the employment front. How do they weigh those things going into that meeting? I'm not going to ask you to make a prediction, but I mean, what will they be looking at?
Well, I think what you're pointing out, Bob, is that recent data, both the employment data and to some extent the inflation data, seem to be pointing toward a stagflationary dilemma. And in stagflation, you have the worst of both worlds. You have inflation rising and unemployment tanking at the same time. Up to now, it partly because we had a view of the employment markets that were pretty benign, the priority seemed to be on the part of the Federal Open Market Committee on the inflation. Now with the, I would say, almost startling data we got a couple of weeks ago that suggests that the overall employment picture isn't quite as rosy as we thought, it's more of a dilemma. It's more of a trade-off. What Jay Powell, the chair of the Fed, has said in really answering the question of how they will weigh the two objectives is it will be an evaluation of how long it will take to get to target, or to get to, in the case of employment, an estimate of full employment if the unemployment rate is deteriorating. By the way, the unemployment rate has not really gone off the rails quite yet. It's other indicators of the employment picture, namely the job creation, that got everybody's attention. So how long it would take to get to target and the extent of the deviation from a notional target for both inflation and for employment. That sounds to me like a very subtle, nuanced, technocratic kind of evaluation. But that's what will happen in the room, is they'll have to make a judgment of which is the more serious situation.